All right. Good morning, everyone. Good morning to all of our board members, our members joining our call today. We're excited to be with all of you guys. Hope everyone is doing okay despite everything that's going on in the world today. We are about entering week 11 of our lockdown, and this is our sixth webinar that we're doing. We've launched this series in April, our global business webinar series, to address some topics that are top of mind to global CEOs today. So far, we started back in April, as I mentioned, with Secretary Kelly Schultz looking at Maryland's pathway to recovery. Since then, we've addressed topics such as global food security, the future of globalization, disruptions to supply chain, and we have other webinars lined up all for the rest of June. So for those of you I have not met, my name is Eddie Resende, and I'm the co-CEO of the World Trade Center Institute, the largest international business networking organization in the area. Let me walk you through the agenda for today. We're going to have 15 minutes with our speaker, our presenter, Anirban Basu, who's going to be addressing the global and US economic outlook. And then we're going to have about 10 to 15 minutes of Q&A. Throughout this presentation, you can submit your questions via the Q&A feature underneath of your screen. And we'll be tracking those questions throughout the presentation, and then I will be facilitating the Q&A towards the end of this call. So today's session is an important one for all of us as we're trying to figure out our plans and strategies going forward. What does 2021 look like? What does the rest of 2020 look like? How do we allocate our resources, limited resources and energy in a time of so much uncertainty? And we're fortunate to have with us our good friend Anirban Basu, who is the CEO and chairman of Sage Policy Group, an organization that provides consulting services to corporations, to governments, and nonprofits to help them provide data so that they have all the tools that they need to make decisions about where to invest their funds and resources. Anirban has been a partner of WTCI for many years. He, as many of you know, is a highly sought after speaker on economic policy and different events that are impacting the economy. And he has also his educational background. He has several masters from University of Maryland, one from Hopkins. He got his bachelor's degree from Georgetown in foreign policy. He also has a JD from University of Maryland. He is the host of the Morning Economic Report at WYPR. He is a professor at Johns Hopkins University and has done lectures at many universities throughout the US. Some of his hobbies, which I saw this, Anirban, on your website, he loves reading. He's a big fan of James Bond. He loves English football and Indian cricket. And we're so excited to have you with us today. If you'll recall, 5 years ago, the first time we had you present at a WTCI event, it was for our EDGE program, where we had you leave Baltimore at 6 in the morning on a Saturday and drive an hour and a half to a horse farm up in Cecil County. Today, we're going to make it a little bit easier for you at the comfort of your home. We're excited to have you, as always. It's an important topic. And thank you so much. What does we're looking forward to hearing from you what the economic recovery look like? Is it a W shape, a V shape, an L shape? Many people are wondering, and I know it's tough to make those calls now, but we always enjoy hearing your perspectives.
Well, thank you so much, Eddie, for that, and thank you to all of you who are with me today. I want to talk about the economy and the economic outlook and how we recover from this. And yes, there's been a lot of debate, as Eddie pointed out, about whether or not this would be a U, V, W, check mark, hockey stick, Nike swoosh, square root, L, so on and so forth. And so we're going to explore some of those issues today. This is your COVID-19 economic update, and then I'll welcome, of course, questions as I get through after I get through this prepared content or ill-prepared content. So thank you. Welcome to June 3rd, 2020, and a very interesting time in our lives, in our nation's history, so on and so forth, and the global history. The year made very interesting, of course, by the coronavirus. Now, there's some good news here. This is global cumulative confirmed cases, January 22nd through June 1st. So these data are current up to 2 days ago. And you can see some good news here, right? I mean, we had a pandemic, obviously, bad news. Many people have passed. We'll never get them back. So in some sense, there is no possibility of recovery. My job is talking about the economy today, but I, like you, recognize this first and foremost as a public health tragedy. And so, but as I say, my role is to talk about the economy, so I'll do that. But we are seeing some flattening of the curve, and every once in a while we'll hear something from Lebanon or South Korea or parts of Germany or today Iran that, as societies reopen, there is a reacceleration of COVID-19 spread, and I suppose that's just something we can expect. And one guesses, at least one presumes, that perhaps all this closeness we've seen in various American cities will trigger a bit more infection in this country as well. We'll see. But there had been some chatter about warmer weather is not good for the virus. But when you look at who's been affected around the world, basically wherever humans live, you'll find COVID-19 infection. And so, whether it's close to the equator, whether it's in Florida or Maryland or Washington states, Mexico or Brazil, South Korea, Japan, or of course China, Western Africa, infection. When you look at the United States, basically wherever people live in large numbers, that's where you see the most COVID-19. Now, it's true the hotspots start out in places like Seattle and New York and so on and so forth, Southern California, but this has gripped the nation. Detroit metropolitan area very much affected. Cook County, Illinois, very much affected. So that's where we are. But again, my job is to talk about the economy and the and the nature of the expansion to come. I do want to point out that some economists, at least, entered this period with some naivete, thinking that we could actually get through this period without a recession. Can you believe that? But if you look at quotes from various economists in late February into early March, you will find quotes indicating that the momentum in the economy at that time, coming into the crisis, the fact that we'd added jobs for 113 consecutive months, the fact that we'd driven unemployment to 3.5%, the fact that wage growth was faster, the fact that there were more job openings than unemployed people. The economy, by some economists, was viewed to be this irresistible force, but that irresistible force hit an immovable object, and that immovable object is COVID-19. And there have been a lot of efforts to try to compare the current episode, the downturn, with previous downturns. From a stock market perspective, I've heard economists try to make comparisons between this and October of 1987 or the dot-com bust. I've heard some people compare this to 9/11. I was on with a very prominent economist on a webinar 3 weeks ago associated with the U.S. housing industry, and he compared this to Katrina in New Orleans, which I believe was in 2005. And of course, many have tried to compare this to 2008, 2009, the Great Recession, which is still, well within the four corners of our memories. But it's not that. Those comparisons are, at least in my view, silly. Because first and foremost, this was not a demand shock. I mean, 2008, 2009 was a demand shock. What happened? People stopped paying mortgages in large numbers starting in late 2005 to early 2006. By the second quarter of 2006, a lot of bad paper was floating around the US financial system. Collateralized mortgage-backed securities. If people aren't paying the mortgages, those assets aren't worth nearly as much. All of a sudden, bank balance sheets are being hammered. Credit is tightening up. Therefore, demand for housing is drying up. But we're building a lot of new homes and delivering them. And suddenly, the money drains out of the system. We have a credit crunch. Lehman Brothers falters on September 15th of 2008, and we have a full-blown global crisis. So what did we do in response? Well, the money disappeared. So the air came out of the balloon. So what did we do? We put air back in the balloon. We had the Troubled Assets Relief Program to recapitalize the banks. So we had quantitative easing. The Federal Reserve blew up its balance sheet from $800 billion pre-crisis to $4.5 trillion. We put air back in the balloon. And I would say it worked. Because that fashioned the lengthiest economic expansion in American history. It drove unemployment to a 50-year low of 3.5%. You would have had to go back to December of 1969 to find an unemployment rate as low as it had been pre-crisis. And just to give you a sense of how long ago that was, the Oreos were good back then. That was a long time ago. But this is not a demand shock. This is a supply shock. This is quarantines, travel bans and restrictions, closure of public places. It didn't matter what the pre-existing momentum of the economy was. It did not matter. This could have happened in 2009. It still would have been devastating because people can't go to work and restaurants are shut down, as are malls and conferences, conventions, so on and so forth. So, what happens? We have factory closures, all kinds of supply chain disruptions, throughout the world, around the world. We'll talk more about this in a moment. Obviously, this is the World Trade Center Institute we're talking about too, and so we want to focus on the global economy. Now, as those enterprises shut down and those activities stop occurring, obviously that triggers a follow-on demand shock. The nation lost 20.5 million jobs in April. The official rate of unemployment in April was 14.7%, but don't you believe it? There was a glitch or a challenge with one of the questions on the survey. The unemployment rate data come from survey data, the unemployment rate estimates. And one of the questions on the survey administered in April was difficult for people to answer. And so based on that, many economists have looked at that, including myself, conclude that unemployment was meaningfully understated, perhaps as much as 5 percentage points. So even by April, the unemployment rate was creeping close to 20%. But again, not reflected in the data, but probably in actuality. And so as people are losing jobs, that triggers a follow-on demand shock, loss of confidence, loss of income, so on and so forth. We'll talk more about this. But this is different. The cure ultimately doesn't come from the federal government. The cure doesn't come from the Federal Reserve Bank of the United States. They can help. They can help the payments out of the economy. But if people can't go to work, they can't produce output. Easy as that. Now, some people can go to work, Amazon workers and those intrepid DoorDash couriers, so on and so forth. But obviously, many people can't. We've had 40 million Americans file for unemployment insurance over the last 10 weeks. That's 1 in 4 American workers. And the global economy, as it turns out, not the U.S. economy. I mean, the U.S. economy was fragile, as it turns out. Some people didn't realize it. I mean, one of the sources of fragility for the U.S. economy was all this indebtedness at the federal level and household balance sheets and at the corporate level. But the global economy was already quite fragile. I'll just pick off the second bullet here. Already, trade wars had pushed global growth in 2019 to its lowest rate since the 0.7% contraction in 2009. The global economy grew 2.9% last year, according to the International Monetary Fund. That's pretty weak performance. I have to say, though, that coming into this year, there was reason for some optimism. There was. Why? Because we got that first phase trade deal signed with China. We got the ratification of the USMCA, the US-Mexico-Canada trade agreement. We got Boris Johnson's resounding victory in the United Kingdom, which gave us more certitude regarding Brexit. When was the last time you talked about Brexit? You've been talking about Boris Johnson a lot, perhaps, during this pandemic, but not so much about Brexit. And maybe I'm wrong about that. But the point is, we haven't had to think about it quite as much. And so all of that uncertainty revolving around the global supply chain and US manufacturing began to dissolve. And not to say there weren't still trade tensions, and we were on the way to negotiating a phase 2 agreement with the Chinese, and that was going to be complicated. Everyone understood that. But coming into the year, the International Monetary Fund said, look, the global economy grew 2.9% last year. We expect 3.3% this year, which is better. A recent International Monetary Fund forecast determined that, no, the global economy this year will not grow 3.3%. It'll shrink 3%. And that figure, I suspect, will be further downgraded. We economists, I think, are fully coming to terms with how bad things are in America. If you look at forecasts from various economists for the second quarter of 2020, and by the way, this is or will be the worst quarter of our economic lives. And if it ever gets worse than this, I don't know that I'm going to be doing webinars for WTCI or anybody else, because those of you this is depressing enough. So when the Conference Board predicts a 44.5% in second quarter GDP on an annualized basis, and Goldman Sachs economy is 39%, and Morgan Stanley 38%, and so on and so forth. I mean, by comparison, during the worst quarter of the Great Recession in late 2008, the economy shrank 8.4%. I was a baby compared to this. Now, of course, we know the economy is bad. I want to get into, obviously, ultimately, what the recovery is going to look like and when it's going to likely begin and how sustained it's going to be. But we know that this has created some further cleavages in our society. You see the frustration on the streets of America, and we can talk about how much that relates to what happened in Minneapolis or what happened in Georgia or whatever it happens to be, Central Park, New York. But people have been shut up for 3 months, and many have lost their jobs. They still haven't been able to return to work. The Federal Reserve Bank of St. Louis conducted a study as the crisis was entering full swing. It released it in late March. From my perspective, and you may disagree with this crisis began in America roughly March 9th. March 9th. You say, Anirban, you're wrong, sir, because they call it COVID-19 for a reason. It was discovered in 2019, sir. Otherwise, they'd call it COVID-20. Yeah, fair point. You scored one on me there. There's no question about that. But here's what I mean. It wasn't until March 9th that the Dow Jones and the rest of the stock market really noticed that there was a crisis afoot. I mean, the trading the previous week, the week that began March 2nd, was lumpy. It wasn't a good week of trading. But on March 9th, the Dow Jones loses more than 2,000 points. At that time, that was the largest single point decline ever registered on a single day. We then set records on March 12th and then again March 16th. It was an awful time for the markets. We go from 29,000 and change on the Dow to 18,000 and change on the Dow in the blink of an eye. At that point, people realized that this is a real economic event. But it wasn't until that point, I think, that, look, in late February, you and I were social distancing to a certain extent. I mean, when we were in each other's presence, we might fist pump, and some of us were doing the elbow bump. Others of us were doing the kid and play toe tap. But again, as I say, the markets didn't really wake up until March 9th. And then, boy, we all woke up, didn't we? So as I say, this Federal Reserve Bank of St. Louis study looked at who's at greatest risk of layoff. So if you look at the second bolded row here, employed in occupations high risk of layoff, 46%. And who are these folks? They're in food preparation. They work for restaurants. They're in sales. They work for retailers. They work at the mall. And they can't work remotely. I mean, a lot of us on this call, we're fortunate, aren't we? And we've recognized how fortunate we are, because a lot of us, not all of us, but a lot of us can work remotely. But a lot of people can't. And people in production occupations, for instance, people in manufacturing, when General Motors, Ford, Chrysler, BMW, others shuttered their plants. I mean, obviously, you throw a lot of manufacturing workers out of work. And then all those folks in installation, maintenance, and repair occupations. I mean, who's inviting electricians into their homes, plumbers, so on and so forth? Not many people, unless it's an absolute emergency. So when I say that the unemployment rate could ultimately peak, in this country around 25% of the cycle or something around that, that's not unrealistic. Because the monthly and quarterly data have failed to fully capture the devastation, didn't quickly capture the devastation, we've been looking for some, what I would call high frequency data. And some of the most high frequency data are unemployment insurance claims or initial claims for unemployment insurance. So those come out every week. And so by late March, we had a week, the week ended March 28th, that we had nearly 7 million people file for unemployment insurance in a single week. Now, the good news here is that steadily that's been declining. For the week ending May 23rd, we're down to 2.1 million. But pre-crisis, about 210,000 people were filing for unemployment insurance during any given week. And as I say, 40 million Americans, actually a bit more than that, roughly 1 in 4 American workers has filed for unemployment insurance. But here's the thing. This can be misleading. Why? Because it is conceivable that someone would lose a job, file for unemployment insurance successfully, and then get a job the next day. I'm not saying it happens often. I'm just saying it's theoretically conceivable. But given that, what might matter more are continuing claims. How many people are on unemployment insurance right now? And one of the reasons that people have wanted to go on to unemployment insurance is in some cases they end up actually making more money, right? $600 a week in federal supplemental unemployment insurance benefits on top of state benefits. In some cases, there's plenty of anecdotes of workers asking their employers to lay them off so they could get the benefit of that as quickly as possible. I mean, they'll come to work eventually, many of them, most of them. Now, this is continuing claims for the week ending May 16th, and this is the most important slide of my presentation because it hints that recovery has already begun. And I know it's hard to see through the fog of protests and so on. So I know we all have different opinions about these things, and that's fine. But my job again is to talk about the economy. But I want you to note that the S&P 500 today is up 27 points. You say, how can the S&P 500 be up 27 points, sir? And it's been up. The Dow is up 278 points. You wonder, are these investors not watching CNN or MSNBC or Fox? Do they not see what's happening? What the market participants see is happening is that as the economy opens back up, people are more anxious to get in there and shop and engage and interact than people thought they would be. Which, with the implication being that revenues are going to grow faster than many people thought, with the implication that earnings are going to be stronger. And of course, that's what you're buying when you buy a share of stock. You're buying discounted value of future corporate earnings. And this notion that this recovery has already begun is reflected on this slide. And there's more. I mean, when you look at the recovery in the Dow Jones, not to say the stock market is a perfect predictor of anything, not at all. I'm not suggesting that. That would be naive. But if you think about what's happened on the Dow Jones as an example, Dow starts at 29,400 roughly during the crisis, comes down to 18,000 or so during the worst of its trading, and then has shot up more recently back up towards 25,000. That's a V. If you graph that out, that's a V-shaped recovery. It's actually 26,000 this morning now. We're up above 26,000, 26,010.74 to be precise. This comes from Oxford Economics. Not too much stuff going on this slide by half, but there's two lines here. There's a red line here, and the reason I picked Oxford Economics is I think they do a whale of a job forecasting. They bring common sense to their forecasting. So you see the red line there? That's the January forecast for global growth. And the way this works, it's an index. So the fourth quarter of 2019 is set equal to 100. And then you can see, their forecast pre-COVID-19 or pre-COVID-19 effects. It's the global economy recovers. We have first phase trade deal between the United States and China, ratification of the USMCA, trade tensions are abating, Boris Johnson's big victory in the United Kingdom. I'm not saying I'm a big Boris Johnson fan, but the point is we haven't had to talk about or think about Brexit as much. Now the blue line is the current forecast. And what do you see there? A sharp dip in activity. The global economy is shrinking about 10%. If you look at the index value from 100 down to roughly 90. But then what do you see after that, ladies and gentlemen? Look at that. You see the letter V. V for victory. And that's the way this recovery is going to be. It's going to be an awkward V because a V is made of two linear segments that are of equal length. In this case, the V will be of two linear segments in some sense, but the part of the V that goes downward will be lengthier than the one that goes back up. Complete recovery will prove elusive for years. And I think it's going to be a V, not because Oxford Economics says so. I mean, I'm glad to get that validation. I think it's going to be a V because that's where it has been. So again, too much data on here by half. This comes from Goldman Sachs. But if you can just pick out one line here, the blue line here, the blue line that goes way up to the top and back down again, that's a characterization of Hong Kong's economy, Sars Epidemic, 2003. You see the skinny black line at 0%. So as the pandemic or epidemic breaks out, growth goes below that pre-existing average. Of course it does. And then as more industries are hit, so first it's travel, and then leisure hospitality, and then financial services, real estate, whatever it happens to be, things get worse before they get better. Well, we know that. We've seen that. But then what do you see after that? A sharp bounce back in economic activity. There are a lot of V's on this slide. That's the nature of recovery that we have observed based on previous pandemics. And by the way, there's some other reasons to think it's going to be a V. The initial phase of this recovery, which begins at some point in the third quarter in earnest, will be sharp. There's so much stimulus in the pipeline. But unlike with September of 2008 and the global financial crisis, Congress didn't wait this time to act. By March 6th, so that's 5 days before Utah Jazz center Rudy Gobert is diagnosed with COVID-19, and people really start to become aware, my goodness, we're at risk here, personally. They had already passed an $8.3 billion package supplying emergency funding. 12 days later, phase two, the Family's First Coronavirus Response Act, $192 billion. And then the big one, phase three, the CARES Act, more than $2 trillion. And then they followed that up with more money less than a month later for the Paycheck Protection Program and some other elements, which was nearly a $500 billion package. And as you know, there's another package that's been passed by the House of Representatives that's $3 trillion in size, including assistance to state and local government. State and local government has become a weak spot for this economy as state and local governments have to balance their budgets each and every year. If you look at another reason to think it's going to be a V, the household savings rate in April rose to 33%. So some people got those $1,200 checks. Some people have been getting those unemployment insurance benefits, and they've been stockpiling cash. Cash has been coming in. They haven't had an opportunity to spend it. When things start to open up again and people start to engage in the economy, there's some dry powder there. So forecast, look, recession is in full swing globally in the United States. That's obvious, but I still expect this to be short and vicious. Look, if you measure the V from the perspective of days and weeks, it's not going to be a V because the economy is opening gradually, and we've had these protests taking place, and that's affected certain small businesses and all those kinds of things. Yeah. But if you look at this from the perspective of months and quarters, it's going to be a sharp bounce back later this year. Now, the best positioned people work in the public sector. They, generally speaking, enjoy greater job stability. Not to say that folks who work for the city of Detroit or Los Angeles or so on and so forth haven't lost jobs. The private sector workforce has been absolutely hammered, and I think unemployment is probably now exceeding 20%. We'll see. We'll get some data on the jobs market in a couple of days. I think as economists, we finally adjusted our expectations. They've finally adjusted to the downside. And let me just say that when it commences, I get it. Right now, it's hard to see it, again, through the fog of what's going on in various cities around the country. So proud of Baltimore to see people exercising their First Amendment rights in a nonviolent way. It's been a beautiful thing to watch. But when it commences, the recovery from this crisis will be sharp, profound, and most welcome. And that's what the markets are picking up. Look, when people get back into the economy, interest rates are low, pent-up demand for things is going to be high. There's going to be some cash on household balance sheets. There's going to be a need to rebuild inventories, including at auto dealerships, and people are anxious to meet again. And that's what we're seeing. That, about 5 days ago, we realized that the Urban Outfitters in Towson had reopened. And who was in the Urban Outfitters store immediately as they learned that it had reopened? My two daughters and my wife. And they were having a great time. Who was having a lousy time at that Urban Outfitters? Me. But they want to meet again. They want to go to restaurants. They want to see a movie, and not on Netflix and not in their house. They want to watch the Baltimore Orioles, which is the most beautiful thing a human being can do short of nurturing a child, and engage in other most wonderful human activities. They want to be out there. And part of, I think, these protests is people have been disconnected, and this gives them connectivity. And they're going to soon engage the economy in meaningful ways. Expect a vigorous recovery during the latter half of the year, assuming, of course, this virus does not reemerge and we have a better medical toolkit come October, November, and December. And with that, Eddie, I'll give it back to you.
All right. Thank you, Anirban. We have a few minutes for questions, and Anirban can stay with us a little bit longer in case there are extra questions. Feel free to share them in the Q&A feature underneath your screen. Anirban, let's start by talking a little bit about you mentioned the phases of the stimulus and how we're adding 1.7 billion to the deficit, which is already very large. As you know, China, Singapore, other countries own a lot of that debt through treasury bonds. What happens? What are your thoughts on if these countries decide to cash on this, and especially with all the tensions, their needs to stimulate their own economies? What's the long and term impact of this deficit? Yeah.
Well, I mean, look, here's the thing, Eddie. Right now, I'm looking at a 10-year treasury yield of 0.756%. Let's call it 0.76% just for kicks. And so the bond market is willing to lend to the federal government on a 10-year basis at less than 80 basis points. So there's no crisis right now. The national debt coming into this crisis was $23.5 trillion. We'll end up adding $5 to $6 trillion to the national debt over the course of this crisis, given the CARES Act and so the loss of revenues and all the rest of it. So let's say we end this crisis at around $30 trillion. But people around the world are still willing to hold this debt with very low interest rates. And actually, interest rates have been going up a little bit more, which is consistent actually with the notion that people aren't willing to just sit in safe assets. They want to engage the market. Confidence is actually rebuilding out there in financial markets. So when do I think the crisis is going to blow up? My best guess, Eddie, 2026. Why do I say that? That's the year that Medicare goes insolvent, according to the most recent trustees report. And at that point, you're going to need some real adults in Washington, D.C. crafting a budget. You can't, as a country, run trillion-dollar deficits during the best of economic times. You've got to show some discipline. And we haven't shown that discipline for years. And it's going to come back to bite us eventually. But it's not today, and it's not next year, and it's not reflected in the bond market. That much is clear, or in yields. So we'll run into a crisis at some point, unless we have some adults in Washington, D.C. Obviously, we just don't have many of those right now.
Got it. Thank you. We've got another question from one of our callers today. What type of reoccurrence would impact the upward slope of the V recovery?
Well, that's it right there, right? So as I say, the cure doesn't come from the federal government or the Federal Reserve. It comes from Regeneron, Gilead Sciences, Pfizer, Merck, Sanofi Aventis, Moderna, Novartis, somebody in the life sciences community that can figure this out. Anthony Fauci has been talking about, mass vaccination by later this year, or early next year, so on and so forth. Um, so, that's an epidemiological issue, right? The virus likes colder temperatures. It likes people sneezing and coughing. It likes low humidity. All the things that October, November, and December bring to us. My feeling has been, and it's an article of faith really, more than something scientific, is that the medical toolkit come the fall will be far superior to the one that we had in January, February, and March, when we really didn't have a medical toolkit as well, at all. We already know that a Gilead Sciences drug, remdesivir, has some clinical efficacy. So we're building on that. And we have, I think, more testing, more PPE, more ICU beds, more ventilators. So we're better prepared. And so the rationale to shut down the economy may not be there, even if we see a pickup in spread, because the healthcare system will be able to handle it. And, of course, we'd love to have a vaccine.
Got it. Thank you. A great question from Bruce McIndoe, CEO of World Aware and board member of WTCI. Going back to talking about your outlook, and especially with the relations with China, what do you see as a potential shocks to this outlook as the U.S. Cuts relations with China, and like cutting the China from the U.S. dollar? What's the impact of that in the economy?
It's massive. So, as I say, the initial phase of the expansion, I think it's going to be quite robust. It'll be incomplete. And then I think, you mentioned the letter W in your introduction. We could have a W-shaped economic event here. So at some point, once the stimulus works its way through the economy, this economy is going to be vulnerable, right? People have spent a lot of that money already. We'll be left with, damaged balance sheets, weakened state and local government budgets. And at that point, you might see the economy begin to sink again. And who knows what the policy making in Washington, D.C. will be at that point, because now we're talking about after the next presidential and congressional elections. And then on top of that, you've got fragmenting global supply chains. There's so much anger out there. And there's so many American CEOs talking about reshoring production. And there are Chinese policymakers saying, look at America. Don't talk to us about Hong Kong, look at Minneapolis. And all of this rhetoric just makes things worse for those of us who like free and fair trade, right? Those of us who grew up in the 80s and 90s and watching free trade, blossom around the world, in the European Union, and the end of history in The Last Man, written by Francis Fukuyama. And this is not supposed to be happening 20 years later. This should be just kumbaya and holding hands, and just watching football and soccer all day long. And tennis, obviously, and Tiger Woods. That's what this should be about, but it's not. So yeah, I think the global economy is becoming fractured. Global trade routes are being broken. Supply chain disruptions are becoming more commonplace. And that's one of the reasons to be pessimistic after the early phase of this expansion. I don't want to talk about that because I wanted it to end on an upbeat note. But if you invite me back at one day in the future, we can talk about that.
We will definitely invite you back. We got one more question, and this is something that obviously many families around the country are talking about. In order for people to get back to work, schools need to reopen. What are your thoughts on schools and colleges? What's going to happen in the fall?
Yeah, this is interesting. This is really a political dynamic, right? So I can tell you this. I bet you that Georgia is going to open its public schools on time. Right, because that Governor Kemp, he opened up right away. He was like, I don't care what the medical people say. I'm opening this thing up again. And as it turns out, there has not been a resurgence of viral spread in Georgia. And part of that, of course, is because the city of Atlanta followed a different trajectory. But nonetheless, so if Georgia opens up its schools on time, if I'm right about that, again, that's a political outcome. Guess who also has to open up their schools on time? South Carolina. And boy, if South Carolina does it, you better believe North Carolina is going to do it. And the Virginians are not going to be outdone. And then who's next? So there's going to be a lot of pressure on university presidents and on public school administrators if one system opens over here, those kids are in school. Our kids are falling behind those kids. Do something, open up again. And again, the hope is what? That our medical toolkit is just much more exquisite come September, post Labor Day, than it is now. Look, the world changed in 3 months, right? From early March to early June, it's a different world. Why would we not expect that by early September, it's going to be a different world again? I expect that. And if I'm wrong, I'm wrong, and I'll live with that.
And then if there's a second wave of outbreak, which a lot of people are talking about, obviously it's a challenge for all of us as we plan, whether you're a university or a business. How do you plan for a potential second wave of lockdown?
Yeah, you develop really tight and implementable standard operating procedures and protocols. I just wrote an article about this for the U.S. construction industry. Contractors are going to get back to work, and there's going to be a dearth of demand for new construction, but you're going to see a lot of work being done to upgrade existing facilities, including HVAC systems, because one of the things that can happen is air handling systems can spread the virus. So what you're going to have is a lot of construction workers alongside patients and caregivers, office workers, so on and so forth. And so you've got to, if you're a construction firm or any firm, you've got to establish protocols. In construction, we call it pre-construction. You've got to engage in some pre-construction activities. Think about how this is going to work, how construction workers are going to engage one another, and how they're going to engage the customers. If you're the NFL, you're thinking about this during preseason. If you're Major League Baseball, you're thinking about that right now. And so we've got to come up with protocols. Who has to wear a mask? How often do they have to be worn? What about social distancing? Do we have to be 6 feet apart? We're going through that right now. Restaurants around this country are dealing with this today, right? Do they have space for outdoor dining? How can they seat enough people and make the enterprise go if they're all 6 feet apart? I mean, does that work? Or the tables? And so people are wrestling with this, and that's part of the hesitation here in believing this is going to be a robust recovery. But that's what's going to have to happen. And you see it at Disney in Shanghai. You see it at Disney in Florida. They're making it happen. And we're coming back. And here's the thing again, people are racing to go to Shanghai Disney, racing to get down to Florida so their kids can enjoy themselves, even if they have to stay 6 feet apart from other kids. And so that's where we're at. And, like I say, come on, Gilead Sciences, please, Regeneron, Pfizer, please do something about this, Merck, come on. And I think it's going to happen eventually. We've got over 100 clinical trials and preclinical trials taking place in this country. We've got over 100 shots on goal. Somebody's going to score.
Well, fingers crossed for good news. Also, I always like to leave our members with a question, and I love hearing your answers on this. If you are sitting on cash right now, where do you invest your money?
If you're sitting on cash right now, I'm a little scared to deploy it too quickly. I still think cash is king. And for enterprise sustainability, retaining a healthy dose of cash is a good thing. I talk to a lot of people right now who are watching the Dow Jones. It's up 317 points as we're speaking right now. They're saying, I need to put my money back in. Look, in my mind, there's a departure right now between how the markets are functioning and what is the reality of the underlying economy. Yes, the economy is going to come back to a certain extent, but maybe not as sharply as the Dow Jones and the S&P 500 have recently. They're within spitting distance of their all-time highs at this point. And so the Nasdaq is at 9663. Its all-time high was 9800 on February 19th. So it's within 150 points of its all-time high. But the economy is nowhere close to being anywhere close to where it was in February. So be careful. Treasure that cash. Welcome that cash. Be thankful for that cash. And don't think that you might not need that cash, because the economic future is still very uncertain. Even if I'm right that the initial stage of the recovery is going to be robust, thereafter, there's going to be a period of significant economic uncertainty globally and in the United States.
Perfect. Well, thank you so much. I know we're a little bit over our time. I'm going to ask my colleague Maggie to share our slide on upcoming programs. We are going to have a chance to actually hear from you again. We're partnering with the Regional Manufacturing Institute. You won't see it on the slide here, but on June 12th on the session on reshoring. So anyone interested in that, let us know. Should be a great conversation, and we'd love to hear more on your thoughts on bringing jobs back to Maryland. And if not, mail in the US or other parts of the world. And 2 other programs we have coming up: our webinar on June 12th, The Disruption Dilemma, How to Pivot from Crisis to Success, with our partners in Mind Over Machines. And then on June 12th, we have Negotiating in a Virtual World with Jeff Cochran of Shapiro Negotiations Institute, a partner for us with the EDGE program, and a great resource and wealth of knowledge when it comes to negotiations. For those of you new to WTCI, I would encourage you to stay in touch with us via social media. You can find our information above. And to learn more about membership, you can reach out to my colleague, Lydia Yodi, Senior Manager of Business Development and Membership. Anirban, thank you so much for joining us. We look forward to continuing our discussion on the 12th and to partnering with you on many other future WTCI programs. Thank you to the WTCI team and all of you who joined us today. We'll see you next time.
Thank you.